Hello everybody, this is AK. I'm back. So on screen you see a screenshot of a blog post I published 4 months ago on how fixed deposit interest rates were declining and that they could soften further, and that has played out. And at that time I said I was locking in a 3.92% per annum return, and that was for a period of 2 years, right? I think that blog post would provide an interesting backstory to this video, so I'll leave a link in the description below and you can read that at your own leisure. Okay, today I'm going to talk about how I'm going to lock up some more money for 3.6% per annum for the next 9 months, and this is in a fixed deposit by CIMB. And why am I doing this? Right, like I say, I think fixed deposit rates would probably decline in the next few months and through next year. That's one reason, and many experts are saying that the Fed in the US would probably start reducing interest rates sometime in 2024, right? And the expectation is because the US economy could see a softening or a soft landing, some kind of weakness, and inflation comes back down. There's no reason for the Fed to keep interest rates at such elevated levels for a very long time, although there's no expectation for interest rates to reduce all the way back down to 0% or close to 0%, but some reduction in interest rates is expected by most experts I've read so far. So if I can lock in a higher interest rate now for the next 9 months to a year, it's not a bad thing, especially if we expect some kind of softening in the economy to happen in 2024, which probably means that we might see stock prices coming down, right? As it is now, the front end of the yield curve is still elevated. The yield curve is still inverted, and that has historically been a very good prediction of an oncoming recession. We just don't know when it's going to happen, but if it happens, we want to have some money ready. So locking up some money right now for higher return makes good sense to me. Of course, if you have been following my blog or listening to me talk to myself in my videos, you know that I have a T-bill ladder, right? 6 months T-bill ladder where I put money, I sock away money every 2 weeks into T-bills, and which basically means that I have money coming back to me every 2 weeks because my T-bill ladder was completed a few months ago, and I'm strengthening the ladder now. So if there should be an opportunity, Mr. Market goes into depression and I have a chance to buy cheap from Mr. Market, I have money coming back to me every 2 weeks, which I can use to buy T-bills, right? Of course, if Mr. Market should have a huge depression out of sudden and the market suddenly crashes, for some reason by 20-30%, that kind of thing, I don't know what might trigger that. Usually we don't know why a stock market crashes until it happens, right? I don't know might trigger that, but it makes good sense to have a chunk of our money also in high yielding savings account like the UOB one account, right, which pays up to 5% per annum on average if we have about 100k with the bank account, in UOB one account about 100k, and we meet all the conditions, right? And that 100k is probably a significant sum of money to many people, and if we have that and we can deploy that immediately on the same day, if the stock market should give us some kind of drastic opportunity, or the next day, very, very quickly you can withdraw the money and use it. But the T-bill ladder is there so that you have money coming in constantly, right, which you can use. I mean, an event where the stock market drifts down, you know, the stock market, there's a saying in technical analysis, stock prices they'll go down a river of hope, right? So in a situation where the economy is weaker, it's recessionary, for example, that could happen, and having money coming in constantly every 2 weeks would give us a chance to buy on a more regular basis. Right, then why am I locking up some money in the 3.6% per annum fixed deposit for 9 months? Why don't I just simply buy more T-bills and every 2 weeks? The reason is quite simple. With fixed deposit, it's far easier to break than the T-bill. I mean, T-bill, and also the fact that with a fixed deposit, we won't lose money on the fixed deposit, right? With a T-bill, if we want to get the money back faster, we can sell it in the market, but there's no guarantee that we can get back, right, the entire sum of money, or we could break even taking into consideration the coupon that we receive upfront, right? So with fixed deposit, there is that flexibility of allowing us to break very easily by just informing the bank, and we can get the money back immediately, right, which we can use for buying from Mr. Market if he should go into a depression. So that's a reason. And I think 3.6% per annum for 9 months is very decent, especially if you think about this, you extend into next year sometime in May, so middle of the year. So if that's when the Fed starts cutting back interest rate, for example, and which might mean that, you know, the economy is softening and not doing so well, it could be a nice timing to get back more money to tap on opportunities as well, right? And for those of us with itchy fingers, who always looking at the stock market and buying this and that, for example, locking up money is also one way of ensuring that we don't let our itchy fingers use the money as and when we see something we think we want to buy. So like Charlie Munger says, right, it takes character to sit on all that cash and just wait for the next opportunity, right? So locking up some money from time to time, I think, will help us, especially those of us who have itchy fingers. Okay, so thank you very much for watching this video. If AK can do it, so can you. Bye bye.